So once again, we're seeing rates rise, although not full points every 3 weeks, but still they're going up, probably going to go up again next week. What does that mean in a broader sense for an investor? I mean, this is a different world than we've seen for several years now.
Yeah. Well, look, I think if you look at a longer time period, think of it from a strategic point of view, investors have been investing really in equities and very little in fixed income for 15 years. And people have moved away from negative interest rates. They've bought private credit. They've bought private assets. They've bought equities, assuming that that's where the return was going to be. So now you have a paradigm shift. And, you can't say, well, this is what I'm going to do with my money tomorrow. But over the next 18 months, you're going to see significant shifts of capital into the fixed income complex. That'll include longer duration securities. That'll include high yield securities. That'll include investment grade securities, which for the first time will actually be attractive. And it'll include the short duration complex as well. I also think, interestingly enough, emerging markets has got to be a place where you look. Emerging markets are down. The MB is down 20%, maybe 16% as of today. And it's probably got a yield of 8%. Next year, if everybody's predictions are wrong and the Fed doesn't raise rates by much, because everybody thinks rates are going to go down, then more than likely you're going to see some recovery in emerging market debt, and that could yield 8% plus some price appreciation. You can see 10. So frankly, that's a place where I don't think people are looking, and I think probably it bears some thought.
If you take what Peter said, Liz Ann, ultimately, does that end you up in cash? Because that's the shortest term investment. You can move that around quickly, and maybe you have to get ready for a bounce back in 18 months.
So I think it depends on who the investor is. I think for investors that are much less risk tolerant, that if they're, and I'm talking from the perspective of individual investors, if they're older, if they're in retirement, they were forced way out the risk spectrum in a zero interest rate environment. And for anybody that doesn't have a high risk tolerance, that have those liquidity needs, that have the need to live off of income, getting a real yield on a cash-like or a very short-term security, that's the first time they've experienced that in quite some time. But I also agree with Peter. I think there are paradigm shifts that happen when you go through cycles, particularly when you go through a full cycle where you have an economic contraction and you go from a bull market to a bear market into a new bull market. There's always that recency bias. There's always that obsession with looking at what had been the leadership and feeling that there's not going to be momentum in an asset class unless you go back to that leadership. Leadership changes. I think there is opportunity in fixed income. I think there is opportunity in international. We've got to look through the windshield, not the rearview mirror.
It's interesting. I just saw a note from Rock Creek, offsetting best losses note, that said something I hadn't focused on, which is actually one of the winners this year has been Latin America. That Latin America has done surprisingly well. I've not been paying any attention to Latin America at all, I must say.
Mostly commodity-driven, oil-driven. That's what was driving that. But look, I don't think that we're saying don't invest in equities. I just think that when you look at where your money is allocated, you're going to start to allocate more money to the fixed income complex. And pretty much, you're going to go through a period of volatility here where private assets are probably going to have some challenges. You won't be able to get any liquidity there. You're just going to have to hold them. So you're going to have opportunity losses there. You've seen some of that already in these large pools of private assets that have cash withdrawals or cash requirements. And I think you're going to continue to see that as people try to take their liquidity and get 8 to 9%, which they haven't seen for 15 years.
Listen, on this program, you've talked about a form of factor investing, different factors. I wonder if one of the factors is ability to service debt. I mean, we're starting to see now, as the interest rates go up, some companies are starting to struggle a little bit with paying back. We had Carvana go into a restructure this week of some of its debt. Are you going to have to look at that factor about servicing debt?
I think so. Self-funding. Strength of balance sheet, high cash, lower debt, the ability to service your debt more easily. And you and I were talking before we came on about you don't wish ill on any company or group of companies or their employers, but what's happening now with this move off the zero bound is not just opportunities in asset classes like fixed income, opportunities for active, operating on a more level playing field relative to passive. But I also think price discovery is coming back into the mix, reconnection of fundamentals to prices, and maybe not an environment anymore that just keeps zombie companies afloat for year after year. And we're going through that.
A simple way to think about what what we're talking about here is if you look at the various different credit cycles we've had since really 2000, in each case, there are between 150 and 200 defaults and between 1,000 and 1,500 downgrades. So this is a credit cycle that probably is not as severe as '07, but it's not benign. It's not zero. We know that the economy is going to slow. We know the revenues are going to begin to reflect the financial constraints of the Fed. So what is the default rate? Is it 100? Is it 200? Is it, are the downgrades 1,000 or 1,500? Is the market price for that? Are people ready for that? I don't think so. And I think it's impossible for that not to happen.
Well, listen, I wonder if people are ready for something else. Something that's different, I think, than, for example, '07, '08, is how much of it's private. Peter mentioned earlier private credit. We have private equity. We've got a lot of things that are not as discoverable and are not marked to market, frankly.
Right.
And I wonder if the market's prepared for that. There could be more damage out there than we know exists right now.
I think you're right. In fact, I've looked at data on the broad cohort of foundations and endowments, and just over the last 20 years, looking at their allocation to traditional equities, fixed income, and to the private markets, inclusive of PE and venture. And it's more than doubled. It's 50 to 55% of exposure to the private markets. And at a point where there's liquidity needs and you've tied up that liquidity, I think it's a very different environment in the next few years relative to what it's been in the last 10 to 15.
It's a really important point, Peter, and I don't know if this is connected or not, but we saw Blackstone have issues with their REIT and really shut down some of their withdrawals, and then their private credit. And there may be no problem there at all, but it may be as people feel more pressure, they need that liquidity and start to take it out of some of those funds. It may not be that easy.
Well, I was referring to that earlier. I don't think there's going to be a run on the bank in either B credit or B REIT. On the other hand, I think it is crystal clear that the investor is concerned about the potential marks in those assets and the lack of liquidity that they have. And so that's a temperature gauge on the point that Lizanne is mentioning. Look, think about it this way. We've been running interest rates at basically zero cash and 3 to 4% spreads. Now we have 4% cash and 5 to 6% spreads. And your income, your revenues probably went up because of inflation, but your units that you're selling probably went down. And so your fixed charges have changed dramatically to the negative. Now, you don't have to refinance in 2022. You may not have to refinance in 23, but by 24, you're refinancing. And when you refinance, the bank's going to say, not sure I'm as comfortable with that much debt. And that's where this restructuring is going to take place.
Well, and let's add one final point on this. It's a question of who's temperature, who's comfortable also. Because it's one thing for an institutional investor who's used to this, can ride it out, no problem. We have a lot of retail investors now who are participating in some of these funds.
And that is where the absence of liquidity, they might not even have realized it. But when push comes to shove and they need that money, it's harder to access.
So is there a problem in private credit, do you think, overall right now?
There is an unrecognized loss. There is a restructuring activity to come, and there will be investors who conclude that locking up their liquidity for what you get in private credit is not as attractive as owning liquid securities, which now are actually providing attractive returns. So to the point made earlier about where the allocations of capital go, we've seen 15 years of money moving from public equities and public debt to private credit and private equity. That's going to reverse. It's not going to zero. It probably isn't going back to where it was, but it's not going to keep growing.
Last thought, Lizanne, is there also an opportunity? Usually when there's some destruction going on, when there's some tension, there's some bargain for somebody to come in and say, I can pick it up pretty cheap.
I think that there are opportunities. Some of the rallies that we've seen this year that have not been long-lived have been way down the quality spectrum. There are times where you want to go down the quality spectrum when you're pricing in a real significant pickup. I don't think we're there, but the opportunities come with what's dear. Look for companies with positive earnings revisions, with strong operating leverage, with strong balance sheets. So there's ways to navigate.